Welcome to Believing the Real, a series of talks on the theology of the real. In this chapter 17 of our discussion of the theology of the real, we will discuss the loss of trust in the Great Depression, how loss of trust broke the banks and caused a decade-long depression. Hello, welcome to another episode of Believing the Real. Chapter 17, actually, in our discussion of progress and perfection of the cosmos, of reality, of actually the divine manifestation of the real. And we've been seeing how money is in fact a manifestation of trust between people. We had this conceptualization of the tizurium, a neologism that is in fact an acronym for the inter-subjective world of others represented in our minds. And money is a true manifestation of that, of how the way people believe that something is of value becomes in our minds so tangible, so strong, that we conceive the whole world to be based on this idea in a way that is so tangible that if you don't have this agreed on quantity, this agreed on value, then you can starve. And if you have a lot of it, then you can have a certain place in the hierarchy of man. And so today we will continue to investigate this phenomenon of money. In the previous talks, we reached World War I, and today we will begin discussing what happened to money, what happened to the interaction between people through this medium, this agreed on medium of mutual trust after World War I, focusing on the Great Depression, which was an interesting lesson in the way that this trust can be manipulated and how it cannot be manipulated, and the way in which some of the greatest solutions that were thought up turned out to be even worse than even worse than what they were aimed at curing. Okay, let's get into the actual text that we are studying. We are going to look at a text called it's a book called The Great Depression of the 1930s, Lessons for Today, which is great for us because it projects or actually looks back from what we know about the Great Recession now back to the beginning of the 20th century. It's edited by Nicholas Crafts and Peter Fearon, and we'll be reading considerable excerpts from the introduction, which more or less summarizes the Great Depression for us from a modern perspective. So it has all the advantages of hindsight, and it's a pretty good coverage of what actually happened, and we will be able to see how trust and its expansions and depredations against it actually behave. So let's begin reading. Crafts and Fearon write that the Great Depression deserves its title. The economic crisis that began in 1929 soon engulfed virtually every manufacturing country and all food and raw material producers. So it's not just relegated to America, where the Great Depression was felt very extensively and deeply, but also in other countries all over the world. It was a global crisis, much like the Great Recession of 2008, the consequences of which we are still suffering in many ways. A world at present is what evolved from these calamities of economic interaction in the Great Depression and the Great Recession that actually staved off, most economic experts agree, an even greater depression. Okay, going back to Crafts and Fearon, going back to the text, we can see that they write that in 1931, Keynes observed that the world was then in the middle of the greatest economic catastrophe of the modern world. There is a possibility that when this crisis is looked back upon by the economic historian of the future, it will be seen to mark one of the major turning points. So Keynes was right. Table 1.1 illustrates the movement of key variables in the most important economies during the downturn of the early 1930s and in the recovery that followed. Real GDP, gross domestic product, reached a trough in 1932 and did not regain pre-depression levels until 1936. So, of course, the whole thing about real and unreal GDP, or actually real and nominal they call it, is also a bit of a problem here, because what is real? We will see in a subsequent video that this distinction between real and nominal is itself part of the whole edifice of trust that money embodies. Because when they say real, they mean the actual buying power. But that actual buying power is eternally transformed by the expansion of markets and the innovations that constantly occur within the world of humanity, so that this real is quite unreal. It's a real that is a conjecture, again, in the minds of people regarding the actual value of things that they want to hold on to, notwithstanding their actual price. So it's like the value behind the money, an attempt to get at the value behind the money, but it's not really possible to get at the value behind the money. So it's usually a sort of relative scale that is moved from before and after. So it's like, for example, you see in this table, he compares the real GDP 1929 to the GDP in 2011. And so how is this possible? In 2011, we already began having smartphones. So is this the comparison of the price of a smartphone in 1929? Absolutely not. So what is he comparing? Usually what they can compare, for example, things that were around in 1929 and are still around today. So this real becomes actually an agreed on imaginary conceptualization of what the real is, which is quite unreal. Anyway, that was a digression. We'll have a greatly extended discussion of this issue of real and nominal when we get to talking about inflation in future talks. Inflation is actually a sort of a breach of trust, a gradual breach of trust. We already touched on it in the American War, the way that the paper money that was used to fight the war slowly lost its value as prices rose, which is actually what inflation is about, the gradual loss of trust in the currency. And people are floundering about, wanting to see how they can hinge their trust on something that will give them a sense of permanence. And this thing with real versus nominal is part of that. It's like the real, a very relative index, actually allows people to hinge on it and trust it more than the actual price, which they can see fluctuating before their eyes. So, okay, that's another issue. Let's continue with our reading of Crafts and Fearon on the next page. So, industrial unemployment also reached a trough in 1932, but even in 1937, the best year of the decade, the jobless total remained extraordinarily high. So people, not only the money they had was being depressed, but they also couldn't get the money. The Great Depression caused a major decline in world trade. It was a time of tariff increases, quotas, competitive devaluations, and the promotion of bilateral at the expense of multilateral trade. It is also important to note that the Depression was a time of deflation. On average, prices fell by 28.3% between 1929 and 1933. Even by the end of the decade, prices had not returned to their pre-depression level. The persistent deflation increased the real burden of debt. Here we have the real again, raised real interest rates, and caused consumer and investor uncertainty. Deflation was a major destabilizing feature which policymakers were forced to address. Finally, the data shows that the path to recovery was checked in 1937 when a brief but severe recession in the US affected the world economy. So, in fact, we see that deflation, even though it's not such a high deflation, just 28.3%. If we go to the inflationary side of this equation, when we have inflations, then 28.3% is quite a high inflation, but it is not hyperinflation. We have inflations of thousands and thousands of percents. So it turns out that even a little bit of deflation is catastrophic. And if we look at this from our point of view of trust, then if inflation is the gradual loss of trust in the value of money being exchanged in prices, actually the prices go up as the value of the trust in the value of money decreases, so that people raise the price because they want more money for the same product, as it were. And there's also other reasons. For example, there's a lot of money, then prices go up just to fit the money. So it's not just loss of trust in money, but actually the devaluation of money because there's so much of it. But we'll get to that in the future talk. But devaluation, the way in which the people behave when there's deflation is actually that there is more trust in money than in the value of it. It's like people cling to the money and they will not put it into the market so that it will not be destroyed by market forces. So they don't. So the whole market begins to compress, to go back because of too great a trust in the actual value of money, in the real money. So what we said before about the intangibility of the real versus the nominal, this idea that this is the real value of money, that idea, which is linked to the tendency that we saw to cling to the gold, to hold something tangible, in fact undermines the market. Because instead of putting the money in the market and letting the market expand and putting salaries out there so that people can have jobs, pouring the money in a creative way into the market, people cling to the money and do not use it because they believe that this, but what they are clinging to will retain its value even when it is not used, because it has some kind of inherent value rather than the truth, which is that it has no inherent value whatsoever. Money has utterly no value except what is agreed on by people. So the fact that everything to do with money is actually the tizwurium made tangible is something that lies beyond consciousness. It's like something that underlies the whole economy, but is not. But it's like something, some Freudian kind of repression. Like nobody wants to think about the fact that money is just trust, embodied trust. Everybody wants to think that it is something tangible because all of the things associated with it, the safeties, the security, the power, everything associated with money in relation to other people is actually a lot of the way in which individual people have power over others, interact with others, are able to elicit from others all kinds of things that are often impossible to get in the traditional hierarchic structures that are moneyless. So money is something that is vital for our progress as individuals who become freer as time progresses, more creative, able to manifest their potential in the world. But when people cling to the money, then we get a deflation in which money stops working in the economy and people literally starve. Okay, so let's go back to our reading of Crafts and Fearon. They are now going to speak a little bit about the UK. If we move from the aggregate picture to examine the fortunes of the UK, the USA, and Germany, it is clear that their experiences differed. A study of Table 1.2 shows that the UK fall in real GDP reached a trough in 1931, a modest contraction compared with the fall experienced by the US, trough in 1933, and Germany, trough in 1932. Stock market prices declined in all three countries, but least in the UK. It is also apparent that the early recovery from the Depression was more robust in the UK than in either the US or Germany, though we can note the surge in real GDP during the late 1930s as the Nazi economy became more heavily engaged in preparations for war. Indeed, we will see, as we have seen, that war is always a great way to invigorate an economy because, as we already discussed, in war, one expands without thought of the consequences. So governments pour money, they print money, and they pour it into the economy, and inflation be damned. They want to invigorate things, and it works. And the whole wars have been fought on just paper money, and we will see in the future talk the historical shift some decades later after the Great Depression, when Nixon finally completely divorced the concept of money from any tangible asset. Although, as we already touched upon, this has been replaced by other ideas which are still clinging to some kind of idea of money as something tangible, like the idea of real versus nominal, and we will see other aspects of this later in subsequent talks. So, if we continue with our perusal of Crafts and Fearon, they write that there are other important features of this international crisis which will be analyzed in that volume. In the early 1930s, major financial crises caused panic not just in stock markets but also in banking systems. In the US, for example, clusters of bank failures, especially in 1931 and during the winter of 1932-33, had a devastating effect on the real economy. Across the world, bank failures became the norm rather than the exception. The UK was the only major country where the commercial banking system was robust and the possibility of bank failure remote. In most other countries, credit markets ceased to function effectively and depositors rushed to withdraw their savings as they lost faith in financial institutions. So indeed, this this is truly amazing. Everything in economics seems, very well reasoned and a lot of calculation. There's equations and things are quite complex and so on. And it all seems so tangible. But everywhere throughout the text that we will be looking at, in all economic literature, you always get to the point where the breaking point is around faith. Because people lost faith, they withdrew their money. So what did they lose faith in? They lost faith in the ability of the bank to preserve the money, to give them back their money. You deposited the money, you want it back. But what is that money? It's something tangible? No, it's trust. So they deposited their tangible trust. Now they feel that their tangible trust is going to be squandered, so they want the money before the bank breaks. Because this tangible trust has, in the minds of people, is something real, has become something that is tangible. And when the banks break, then the whole market collapses. So they rush to withdraw their savings, but in fact, when they withdraw their savings, because they lost faith in financial institutions, they are going to break the entire market. Because losing faith means that people are going to put that money, which they believe has some tangible value, under their mattresses. And once it's under the mattress, it's no longer active in the economy. And if it's no longer active in the economy, then they're not going to buy anything, they're not going to do anything, they're not going to put themselves at risk, but they're going to risk their entire world. Because once this distrust sets in, which is actually, as you see here, a trust, an over-trust in the tangibility of money. Because let's say that if people did not rush, did not lose faith in banks, then maybe things would tide over and things would continue. But because they lost faith in banks, they put their faith in money. And they put their faith in the tangibility of money. And since money is only of value when it's working in the economy, when it's being exchanged, and when it's under the mattress, it's nothing. It's all in your mind. It's not. They are taking it out of the tizwurium. They are taking it out of the world where people are inter-subjectively working together. They're not giving it to anyone, but they're sleeping on their money. But when they sleep on their money, it's nothing. Money not working with other people, not interacting, is just in your mind. It's a value in your mind. So, but this value in your mind is something very strong. We will see that it impacts all of world civilization and the way that people treat money. Even to this day, they are seeking the real prices, the real value, and always they are battling the way in which money tends to expand and to inflate, and they are always afraid that they will lose that surplus they have stored. That's another thing that we will discuss at length. The whole thing about money as something working. At this moment, you're using it to buy a baguette or a croissant and your coffee, or or it's in the bank or under your mattress. So these are two different positions in which money serves: as a surplus that you're not using now, and as something that is in motion, that is being used constantly. And it's two different positions, and we will see they have many implications, because this is like equity and debt and so on. There's so much to say about this, and it will slowly unfold as we go through our survey of the history and development of money. Moving on with Crafts and Fearon. We have, as we say, people lost faith in financial institutions, and the banks, of course, were afraid of closing, so they ceased to lend and tried instead to bolster their reserves as an insurance against depositor runs. Again, the banks themselves, instead of putting more money out, they themselves clung to the real. and wanted to keep the money inside them. And of course, this led to business bankruptcies and cutbacks in output, inevitably caused job losses, and also led to a steep decline in investment. As the depression worsened, all governments faced a decline in tax revenue. Everything collapses. Everything implodes. A decline in tax revenue at a time when the need for welfare spending increased. Reductions in public spending in order to achieve budget balance served to worsen the economic decline and intensify misery, which in some countries led to a serious political unrest. Of course, so if everything is imploding, is collapsing, and the market is no longer expanding with money flowing, but rather it's going back, then in fact everything stagnates, because governments can't get enough taxes, because nobody can pay taxes, because nobody is making money. And then how can they help the poor when they don't have enough money to help the poor? And the poor become more and more every day, because there's no money and no jobs, and the people with money are not going to invest in creating new jobs and new places of work, because they are afraid that their money will be squandered, so they sit on it, and so things go from bad to worse. Indeed, we see that the great political upheavals in the world were also associated with this, because if the government can't take care of us, if the government can't arrange for us a market in which we are capable of operating in a good way, then away with the government. And of course, we have the example of the Nazi regime, which offered a very unique solution, a fascist nationalist solution to this problem, and the communist regime, which had another solution to the problem of problems of money. And all these solutions, including the capitalist one, which we are examining throughout, because this for us is the most organic solution. This is something that grows out of people in the most natural way, and also liberates the individual in the greatest way. We're still not there. The individual, there's a lot to say about how the economy may be improved in one of the later talks, but the heart of that improvement will always be how to empower the individual to act in the market more powerfully. I think the best model would be the micro loans given to Indian women, for example, of the poorest castes, and they are now being empowered with micro loans that help them set up their own businesses and become their own women. And this is something, the way, and we already saw how money itself percolates down to the masses, and to individual people, so that they are more empowered to operate in the market, liberating them to seek jobs outside their traditional matrices. And this was part of the evolution of money, and that evolution has not been completed yet, because there are many thresholds, and we will examine them in greater depth later on, that prevent people from truly becoming players in the market, becoming involved in the economy. Many thresholds, especially, for example, in housing, when we will discuss the great housing bubble and bust of 2008, the Great Recession, the initiation of the Great Recession. We will see how these thresholds of the homeless and the homemores, this shift from having property that is considered by people as being of a tangible, real value, and lots of value, and not having that, but having actually to pay a great part of your life stream in order to just have a place to live, to have a roof over your head. This is still one of the great disparities in our money system. And we will look at the example of Singapore, which diverts most of its pension funds into loans available to people to buy their own houses. But that's okay. Again, I'm getting ahead of myself. There's so much to talk about. This thing called money is such a tangible manifestation of trust, of the way people actually interact, and how they make themselves a world that they deem real, and it becomes real for them, even though it's just in their minds, in their ideas, and the way that these ideas can make or break a world. For example, we see here loss of faith in financial institutions just broke the world. So Crafts and Fearon ask some quite poignant questions, which are important for us. They're asking question about the questions. They're saying, what are the key questions that we should ask about the Great Depression? Asking why did the crisis begin in 1929 is an obvious start. But more important questions are why it was so deep and why it lasted so long. Sustained recovery did not begin in the United States until the spring of 1933. Though the UK trough, moving on to page 3 here, occurred in late 1931. And in Germany during the following year. Why and how did the depression spread so that it became an international catastrophe? What role did financial crises play in prolonging and transmitting economic shocks? How effective were national economic policy measures designed to lessen the impact of the depression? Did governments try to coordinate the economic policies? If not, then why not? They did not. Or governments made a lot of mistakes then. Mistakes that, in retrospect, we see them as mistakes, but at the time, people just didn't know how to handle this. They didn't know the core of what was happening. And they're asking, why did the eradication of unemployment prove to be so intractable? In 1937-38, a further sharp depression hit the U.S. economy, increasing unemployment and imposing further deflation. What caused this serious downturn? And what lessons did policymakers draw from it? In short, how can economies be rehabilitated after they have been subject to a major economic contraction intensified by financial disorder? By the late 20th century, write Kraft and Fearon, the memory of international financial seizure in the US and Europe, mass unemployment and severe deflation had receded. Indeed, many policymakers assumed that markets free from the restraints of regulation would be sufficiently robust to avoid another Great Depression. However, during the 2007-2008, an astonishing and unexpected collapse occurred, which caused all key economic variables to fall at a faster rate than they had during the early 30s. As Eichengreen and O'Rourke report, the volume of world trade, the performance of equity markets, and industrial output dropped steeply in 2008. Table 1.1 indicates that the decline in real GDP in 2008-9 was steep but soon arrested. Trade volume declined more rapidly in 2008 than it did in the early phase of the Great Depression, but the decline was only brief. Unemployment rose, but fortunately the problem has not become as serious as it did during the early 1930s. However, the aggregate figures for unemployment mask very serious problems amongst particular groups in a number of countries. For example, the jobless totals in Greece and Spain are a disturbing echo of the 1930s. In sharp contrast with the Great Depression, gentle price rises rather than deflation were a feature of the post-2007 international economy. So we see that, in fact, we have just missed 10 years ago, actually, another Great Depression, and it's now called the Great Recession, because it was stopped in time, as it were, but still hasn't fully recovered. Because, as we will see, as we continue to analyze this from the point of view of the Tiswurium, we will see that, in fact, certain aspects of the way that trust becomes manifest in the intangible of money, or what we perceive of as money, which also evolves all the time, is still not completely understood, so that even though governments now know how to stave off a crash by massive support of their banks so that there can be no run on the bank. When people made a run on the bank remained open because all other banks rushed to support it so that they did not lose faith in the system. So in fact, faith in the system is the solution. But we will see that the other problem, that of overly strong faith in the tangibility of money, still undermines the expansion of the market. And in fact, we are in a sort of deflated inflation or staved off recession that more or less stagnates and keeps on the same level without crashing the market, but not really allowing it to expand as it does in eras where everything is booming and the money is flowing and inflation is rising. So people place less trust in money, so inflation rises, but they place a lot of trust in the market, in the way they interact with people, so that brings a flowering. Okay, these ideas we will work out in greater depth in later talks, but in any case, we see that from the Great Depression, we learned things that helped the system cope in the Great Recession. There has been an evolution in the conception of money that allowed the governments of the world to intervene in this case, and we will see some of these harsh lessons as we continue with our perusal of the Great Depression of the 1930s in Kraft's and Fearon's book. Like the Great Depression, in our times, a full-blown financial crisis quickly emerged. In 2007, the US housing boom collapsed, and subprime mortgages, which had been an attractive investment both at home and abroad, now became a millstone around the necks of those financial institutions that had eagerly snapped them up. As we will see when we discuss the subprime crisis in a future talk, in fact, it's not just the subprime market that crashed, but also the prime. Most of the foreclosures on housing occurred for people who had taken loans in the prime market. They were good bets for taking loans, but the market crashing brought them down, even though they purportedly had the assets. And as we will see, one analyst claims that even if they were backed by 20% assets, which is the criteria, even 40% maybe, then still they would have crashed because of certain implications of the crash. But again, I'm getting ahead of myself. Let's continue with Kraft and Fearon. So as they wrote, the U.S. housing boom collapsed, and subprime mortgages, which had been an attractive investment both at home and abroad, now became a millstone around the necks of those financial institutions that had eagerly snapped them up. The crisis was not confined to the U.S. In August 2007, the French bank BNP Paribas suspended 3 investment funds worth €2 billion because of the problems in the U.S. subprime sector. Meanwhile, the European Central Bank was forced to intervene to restore calm to distressed credit markets, which were badly affected by losses from subprime hedge funds. This is a huge, complex system that we will get into a greater depth in the subsequent talks, because what happened and the way that the market responded can teach us a lot about the evolution of money. But here we are looking over the surface of things and comparing them to the Great Depression. So as Crafts and Fearon write, on 14th of September 2007, the British public became aware that Northern Rock had approached the Bank of England for an emergency loan. So frantic depositors rushed to withdraw their savings. The run on Northern Rock was an extraordinary event for the UK. During the Great Depression, no British financial institution failed or looked like failing. But in 2007, there was an immediate depositor panic. It was clear that without some assurance on the security of deposits, other institutions were at risk. In 2009, UK GDP contracted by 4.8%, the steepest fall since 1921. So we see that all the hallmarks of a crash, of the Great Depression, loomed in 2008. But the lessons learned from the Great Depression allowed the governments to act in time to stave off an even deeper crisis, and in fact pull out of what happened. And if we continue reading in Crafts and Fearon, they write, contrary to the experience of the Great Depression, central banks were quick to respond to the 2008 crisis, both nationally and by cooperation internationally. This is, as you will see when we get deeper into the Great Depression, this is amazing. It's a true learning by humanity as a global entity, as it were, because disparate national entities now collaborated to stave off a global decline, a global destruction of the human market. So interest rates were slashed. Massive quantitative easing was used as a tool to provide liquidity. We will see what this means later on. To provide liquidity to distressed banking systems, and coordinated monetary expansion provided an additional boost. Indeed, both historically low interest rates and a commitment to quantitative easing have been retained by the US Federal Reserve and the Bank of England in order to sustain recovery. So what this actually means is that money was made cheaper and a lot more of it was placed into the market so that no run-in on a bank could cause it to fall, because the bank could always get more money and buy it for cheap. These two means of staving off a continued depression are still with us, even though it's now 10 years since the Great Recession. This is still being used, and we will see a very interesting point in which what they did when they tried to transition out of this full quantitative easing to a little less, provide less than full coverage to the economy, trying to go back to a free market, because this is really government intervention at its best. And what happened then, we will see again how trust and distrust, how faith and lack of faith, or actually the breach of faith, are at the focus of everything economic. Anyway, going back to Crafts and Fearon, they write that fortunately there was no resort to the trade war policies that bedeviled the international economy during the 30s. We'll see more about this later on. Although monetary policy had been expansionary after an initial phase of stimulus, fiscal policy has trodden a different path. Concern over the level of sovereign debt has led many governments to embrace fiscal austerity in the belief that the policy of budgetary consolidation would reduce the burden of debt and also assist economic expansion. In 2008, there seemed a real possibility that the world would be plunged into another Great Depression. Clearly, that did not happen. I'm on page 5 now in the book Depression and Recovery in the 1930s. Clearly that did not happen, but the problem that the world now confronts is that the expansion evident in 2010 has stalled. There is danger that the budgetary squeeze, severe for countries such as Greece, Ireland, and Spain, constrained by the fixed exchange rate of the Eurozone, will cause more pain but not cure the disease. Sustained fiscal consolidation may even transform a world economy now languishing in stagnation into one sliding towards depression. So they're just hitting the points here, but already we see that when there's a fixed rate of exchange, this reminds us of the gold standard, that when governments attempted to enforce a standard on the economy to fix things so that they wouldn't shift too much, they brought about depression. So again, we see that there is a risk here of sliding towards depression because the market is not allowed to expand naturally. So now Crafts and Fearon asked what lessons, if any, did policymakers learn from the economic and financial debacle of 1929 to 1933. Is the fact that the recession that began in 2007 has not, at least so far, descended into mass unemployment, waves of bank failure, trade wars, and destabilizing deflation, the result of the implementation of monetary and fiscal policies that were not employed during the Great Depression? Has enlightened international cooperation replaced the intransigent self-interest evident 80 years ago? Is there a unified view among policymakers striving to promote economic growth in today's sluggish economies? In order to answer these questions, we must first analyze the cause and causes of the Great Depression. So we see that there is a deep link between the Great Depression and the Great Recession, between what happened then and now, because it is one evolving money system. In the same way that we have seen how we as human beings actually subsume within our beings the entire history of evolution from the Big Bang to this day, how every molecule in our body was once part of some ancient supernova or some ancient sun that exploded in an ever infinite expanding cosmos. So we see that in the affairs of people, various lessons are learned. History may repeat itself, but it is not a linear repetition. It's more like expanding cycles in which certain aspects of history are relegated to a niche in which we are able to cope with them. So what we are going to see from the Great Depression is what the world learned about handling the onset of a depression and staving it off. But we will also see where it hasn't learned, because even though a Great Depression was staved off, and in the Great Recession, we see that the world has not really recuperated. So what is wrong here? And I believe that we will see that what's wrong here is that money is not allowed to percolate to the uttermost reaches of the economy, and many people are still outside the interplay of trust, outside the arena of human interaction that money makes possible. And as we saw that the great growth of civilization was enabled when money percolated through all social classes into the hands of the general population, so in this day and age, we still have certain barriers that have to be transgressed in order to enable a true flourishing of world economies. And these barriers surround the ability of everyone to, in fact, make use of the world economy in a way that sustains growth. And that means the debt economy. we will relegate specific discussion to the whole issue of debt, the price of debt, and how debt can be both beneficial and detrimental to potential growth. But just just as sort of teaser for future discussion of this, in the money crisis, in the great subprime lender crisis, as it were, who were those subprime lenders? They were people who wanted to buy homes. In fact, to break into the homeowner bracket from the homeless bracket, to shift from paying rent to a landlord into becoming one's own landlord, or even the landlord of others. So this threshold in society that has become quite deep, in which young people are unable to acquire property, and just dozens of percents of their living wages, of the actual conversion of life into money, that is affected through work. As people work, they convert their life potential into a tangible value that they can exchange on the market. So a lot of this is siphoned off into rent that goes into the income of property owners, who use this to increase their surplus, some of which can go into the market, but some can lie in coffers. And as we saw, this brings deflation and a lot of problems. So there is this interplay of market forces where the threshold bars many actors from getting into the market. And in fact, as we will see when we examine the subprime crisis in depth, that very crisis actually illuminates the way in which many people within our civilization are still outside the actual money market at its best, because they are living from day to day, rather than using that incredible platform that was actually established in the 15th century, as we saw, where your money lay under your mattress or in a bank. Sorry, instead of under your mattress, in a bank, and you gave loans on that. So your money began working in the market. So this ability to use money as both safety and a living quantity of interaction is still relegated to certain strata in society. It is open, there is a lot of mobility. It is open to anyone, but the threshold is getting higher. And we will see this when we, again, go into depth to study what actually happened in the subprime crisis, in the 2008 crisis, the Great Recession. But again, this is a future talk. At the present moment, we are going to examine the historical progression of how people handled money, how governments became more involved after the breaking of the gold standard, and what happened in the Great Depression. So this will be in the next talk. We will begin, actually continue our perusal of Kraft's and Fearon's book, The Great Depression of the 1930s, and the lessons for today, and see what happened and what was learned, and also read between the lines from our point of view of always examining the Tizwurium, the place where everything is representations in the minds of individuals of the intersubjective mind, the intersubjective beliefs, as these are manifested in all areas of life. And in these the current conversations, the current discussions that focus on money as a tangible manifestation of that intersubjective trust.